Share, like, comment, and subscribe.
Right now, somewhere in the ocean, a massive ship is carrying over 1 million barrels of crude oil from the Middle East to Asia. The buyer in this transaction is Japan. They have a highly advanced economy, their own central bank, and their own currency. The seller is Saudi Arabia, an independent sovereign nation with its own distinct financial system. But when it comes time to pay for this shipment, neither country will use their own money. Even though this trade involves no American companies, the entire multi-million-dollar bill is settled in US dollars. We have to ask why two independent nations would bypass their own currencies to rely on American money for their most critical business. To find the answer, we have to look at the daily risks of global trade. At home, the Japanese buyer pays their workers and taxes in yen. Meanwhile, the Saudi seller operates their business entirely in rials. The problem is that the value of the yen and the rial change every single day. If you sign a contract for a 3-month oil shipment and the exchange rate shifts before the oil arrives, one side could lose millions of dollars purely by accident. To fix this, the world uses a stable middleman called a reserve currency. A reserve currency is a universally accepted type of money that foreign governments and banks hold specifically to make global trading predictable. Japan and Saudi Arabia use the dollar as a practical tool for managing this risk because it makes the logistics of international trade possible. How the dollar got this job takes us back to 1944. World War II had left the global economy and international trade networks in ruins. Seeking a way to rebuild, delegates from 44 allied nations gathered at a secluded hotel in New Hampshire. Their goal was to invent a replacement financial system with a reliable standard everyone could trust. This meeting became known as the Bretton Woods Conference. At the time, the United States held a unique position. Its economy boomed, and it physically held the vast majority of the world's gold reserves. The delegates agreed on a mechanical solution. Other nations would peg their currency directly to the US dollar, while the United States agreed to back every single dollar with physical gold at a fixed rate. This agreement officially established the US dollar as the world's central bank account, hardwiring American money into the foundation of global commerce. Decades later, the US ended the gold standard, but the dollar retained its status. A different, universally required commodity took gold's place. In the 1970s, a new arrangement emerged called the petrodollar system. Under this system, global oil exports were strictly priced and sold in US dollars. This created a massive snowball effect. Because every nation requires oil, they are forced to constantly acquire US dollars to keep power grids running. Foreign central banks keep a steady pool of American currency to always buy the energy they need. Linking the dollar to the oil market turned American currency into a mandatory requirement for any nation that needs energy to fuel its economy. Once foreign banks were holding these massive stockpiles of dollars to buy oil, they began using those same dollars to buy everything else. Today, global supply chains for electronics, agriculture, and raw materials are predominantly settled in US currency, regardless of where the goods are made. This is an example of a network effect. A network effect occurs when a system becomes more useful because everyone else is already using it, much like a digital platform that you join because your colleagues are already there. The dollar's primary strength lies in its ubiquity. It is so deeply embedded in the plumbing of global infrastructure that replacing it would require a total overhaul of how the world functions. The oil trade between Japan and Saudi Arabia serves as a clear example of how this network effect governs international business. When the value of the US dollar fluctuates, it instantly alters the local buying power and inflation rates of every other nation on Earth. The US dollar runs the world because the global economy operates like a massive arcade. To keep the games running smoothly, every player has to agree to use the same token.
Share, like, comment, and subscribe.